One of the uses of the risk explanatory models is in a particular portfolio strategy called an alpha strategy. And let me try to explain that strategy. The usual risk identification model, we regress returns on an asset class or country against common global risk factors. We have exposures to those factors, and we also have an alpha. The alpha represents what is not explained given the exposure to the risk factors. So there's a realization of the factor return. We multiply that by the betas, and we get what the model suggests the return should be. And then we actually have a realized return, and that return can be different than what the model suggests. We can think of this as an alpha. It's an alpha that changes every single period. And it's useful to think of portfolio strategies based upon this alpha. In an example I gave in a previous clip, I suggested, well, what if Japan had an oil beta of -1? The price of oil decreases by 10%, and then we see Japan's equity market go up by 5%. Well, the model predicts the market to go up by 10%. It only went up by 5%, so in this case, we would consider purchasing the Japanese equity market. In this case, the alpha, which is defined as the actual minus the predicted, is minus 5%. So the actual return is 5%. The predicted return is 10%. 5% minus 10% is minus 5%. In this case, we've got a negative alpha, but what we're betting on is that that will be wiped out in the future by a positive return. And what we would expect to see would be a strategy that purchased that security with a negative alpha. Now, these alpha strategies are often applied at the individual stock level. So again, it's the same idea. We've got a set of risk factors. We regress at the individual stock level, and we look at the alphas of potentially thousands of securities. And the question is, how would we invest given knowledge of the alphas of these securities? Now, the first thing is, how do you get the alphas? And I've said, well, regress on a set of risk factors. Indeed, there's many firms that actually provide alphas for investment purposes. The first thing that you do is to sort these alphas from high to low and look at the performance of portfolios of high alpha stocks and low alpha stocks. Indeed, in the previous example, I suggested that we perhaps would buy the stocks with a negative alpha. Well, when we look at individual securities rather than asset classes or countries, it might actually be the reverse. And the reason is that the positive alpha or the negative alpha could be picking up company-specific information that's not captured in this risk model. So it might be the case that with the negative alpha, you actually sell those securities, and the positive alpha, you're purchasing the securities. The positive alpha could arise because very good news is happening within the firm that's not being reflected in the exposures to the global risk factors. But the first thing you need to do is to test to see if it works, either by a portfolio strategy based upon a simple sort or a regression of looking at next month's returns regressed on the alphas that were available at the end of the previous month. Both of these are going to yield important information in terms of the value of the alpha approach. Now, there's one further complicating thing. I said that the foundation of this type of analysis is a risk model. And the risk model, we know, we regress time t information against global risk factors also available at time t. It turns out that many practical implementations of these models also throw in, as regressors, company-specific information, attributes like book to market value, the leverage of the firm, industry dummy variables, many things that we wouldn't usually put into a risk analysis. Now, I'm going to argue later on in the course that this is not very well motivated, and indeed, the company-specific information is probably better to show up in the betas or risk exposures. But nevertheless, you need to understand how these models work. So they're a combination of global risk factors and local or company-specific information or industry information. But the idea is very similar. Out of this model, you get an expected return. You look to see what's realized, and there's a difference. Some people call this the alpha. Some people call this the pricing error. It doesn't really matter. Collect those pricing errors for each individual firm through time and see if you can design a portfolio strategy based upon those alphas. This is the so-called alpha or residual strategy. And it's a matter of using this information to design a portfolio strategy.